There's a specific ritual that happens at every car dealership in America. The paperwork is on the desk, the pen is hovering, and the salesman asks how you'll be handling payment today. You, proud of the savings account you fed for 3 years, slide a cashier's check across the desk for $35,000. All of it. The salesman gives you a smile that looks like approval and a nod that looks like respect. You walk out feeling like a financial adult who just accomplished the most grown-up thing imaginable. That salesman is smiling because cash buyers are the most streamlined, profitable transactions on his lot. You haven't won a negotiation. You've just turned a complex trade into the easiest commission of his month. For disciplined people, the traditional advice to always pay cash is quietly siphoning thousands of dollars away from their total net worth every single trade cycle. The rules everybody keeps repeating about car buying were written for an economy that no longer exists. When your parents were buying cars, auto loan rates sat around 8 to 12%, and savings accounts paid you basically nothing. In that environment, paying cash was the only way to avoid arithmetic suicide. Fast forward to today. You can walk into a dealership and finance at 0% on something like a dozen major brands. Meanwhile, online high-yield savings accounts are paying somewhere in the 4% range. When the bank is willing to pay you more to store your money than they charge to lend you theirs, paying cash is no longer a sign of responsibility. It's just leaving money on the table. To see the math in motion, meet Clark and Jenna. They both make $80,000 a year. They both walk into the dealership with $35,000 in savings, and they both want the exact same Toyota RAV4. Clark does the cashier's check routine. His monthly car payment is 0, which feels great for 2 weeks, but his liquid savings account also drops to 0. Every dollar he worked for is now trapped inside a depreciating metal box. Jenna takes the 0% financing deal. She takes her $35,000 and puts it in a high-yield savings account paying 4%, setting up an auto pay to pull the car payment from that account every month. After 5 years, when the loan is paid off, Jenna still has about $3,500 left in that savings account. That is free money that appeared simply because Jenna let her dollars work while she paid the bank back in installments. Holding on to that $35,000 provides Jenna with a liquidity premium, an immediate financial shield that keeps her from ever having to rely on high-interest debt when life gets messy. 18 months later, Clark's secondary car throws a transmission repair bill for $4,200. Because Clark's cash is locked inside his Toyota, he doesn't have the liquid funds to cover the emergency. He ends up charging the repair to a credit card at 22% interest, effectively trading 0% debt for the most expensive kind. The invisible costs continue 2 years later when both apply for a mortgage. Because the lending algorithm views Jenna's history of managing diverse loan types more favorably than Clark's cash-only profile, she is statistically more likely to secure a lowered interest rate, potentially saving her tens of thousands over 30 years. The system rewards this through a metric called credit mix, which accounts for 10% of your score. The algorithm prefers to see that you can handle both revolving credit, like cards, and installment loans, like a car. By avoiding a low-interest car loan, Clark unintentionally made himself look like a higher risk to the bank. His attempt to stay out of debt actually made his future debt more expensive. Even if you don't qualify for 0% financing, paying cash often triggers a defensive reaction in the dealership's F&I office, the finance and insurance room, where the majority of their profit is made. Dealerships often mark up a bank's interest rate by a point or two and pocket the spread. On a $35,000 loan, that markup can be nearly $2,000 of pure dealer profit that you never see itemized on the paperwork. Because cash buyers eliminate that profit stream, dealerships are frequently less flexible on the sticker price of the car. They make their money back by refusing to budge on the one thing a cash buyer can negotiate. The real move is to secure pre-approved financing from a local credit union before you even walk onto the lot. You negotiate the car's price like a cash buyer, and only at the very end do you hand over the third-party loan paperwork. This strips the dealership of their interest rate leverage without forcing you to surrender your liquid savings. There is a completely valid argument for the pay cash side of the debate, but it's based on behavioral guardrails rather than math. With a national savings rate of just 3.6%, the reality is that most people who finance a car don't actually invest the difference. They spend it. They use the extra capital for lifestyle inflation and consumer goods. For anyone who lacks the discipline to save, The pay cash rule is a rigid boundary that prevents them from drowning in car payments they can't afford. But if you already have automated investments and a real emergency fund, following that rule is like wearing floaties in your own pool. You don't need them, and they are only serving to slow you down. 5 years later, Clark and Jenna pull up right next to each other at the exact same stoplight in their identical Toyota RAV4s. Clark is proud of his paid-off car, but he's oblivious to Jenna's reality. She has a funded IRA, a fully liquid emergency fund, and a superior credit profile. This divergence in wealth wasn't caused by a lucky break or a higher salary. It was the result of a single decision made at a desk 5 years ago. Mathematically optimizing your debt builds real wealth, while paying cash simply buys the feeling of being responsible. Stop surrendering your capital for a ritual and start making it work for you. Hit subscribe and click the bell icon for our next breakdown.